Are you interested in investing in real estate? Are you concerned about the high cost of housing? Or in fact, are you really, really in trouble because of it, because it's eating up too much of your budget? Hi, I'm Natalie Pace, and we're going to be talking about housing solutions, whether or not you should buy real estate right now. In fact, is there a real estate opportunity that's lying in plain sight that you should be considering? We're going to talk about private placement REITs. Should you invest in a storage unit or owning part of an apartment building? We're even going to talk about income producing REITs that you can purchase on Wall Street and whether or not you should be looking at those. I'm going to host a private Q&A also on Thursday. So today is Tuesday. On Thursday at 4 p.m. Pacific, I'll host a Q&A about this. So you can watch this, email info@nataliepace.com and say, I want to join the Q&A, and we'll put you in that as well. All right, let's get started. So the first thing that I want to share is what is hiding in plain sight, right? The real estate that we might be overlooking. Now, I have a few things to tell you before we jump right into this answer, but let's take a look at some of the realities here. So, real estate is the best way to build wealth if it's done right. Homeowners are worth 40 times renters in the United States. In terms, that's the median. In terms of the mean, it's 10 times, but it's still really a lot more. It's the greatest way to build wealth because you stop making the landlord rich. And homeowners are worth 40 times renters, the power of leverage. You could turn $600,000 into $1.75 million with two transactions. I talk about that a lot more on day 3 of my financial freedom retreat. I actually show you how that can be done. So consider that as well. I'm going to tell you more about the financial freedom retreat a little bit later on. Here are the topics we're going to cover. Unaffordable housing, home prices at an all-time high, family wealth, gift taxes, intergenerational housing, private placement REITs. Commercial real estate is frozen, but it's also losing value, and it would be down a lot more if it wasn't frozen. Churches into affordable housing, abandoned schools into apartments. Let's get started. So real estate prices are back to an all-time high, and they are unaffordable in many cities. The median existing home price in June was $435,300. It is an all-time high according to the National Association of Realtors. So this is from last year, and it just shows you, of course, how things are. And of course, in the West, they are the most expensive. Now, the interesting thing I wanted you to look at as well is that after the Great Recession, it took real estate 10 years to recover. Also, I get people on the West Coast that say, oh, real estate never goes down here, right? Well, yes, it does. Look at how much it lost between 2006 and 2011. And then again, it took a decade to come back to where it was in 2006, and that's common. So it's important not to be, everybody gets interested in buying real estate because it's like it's been a great investment over the past, since the Great Recession, it's more than doubled. It's been a great investment. But if you buy high, this can be a problem. We're going to talk a little bit more about that too. So it's not just, buying a home is going to be cheaper than renting. That's not just the only consideration. Now, some areas are already starting to lose home value. These are the ones that have gone up the most. So even though they've lost a little bit, it doesn't make them necessarily buying opportunities. Florida, Colorado, Utah, Texas, North Carolina, and Georgia. These are the metros where home prices are softening the most. So again, that you can check these out, but it doesn't mean that they're buying opportunities because these are the areas that actually went up the most and were unaffordable to the people who live there. So this is the unaffordability map. You can see here that they're saying the reds are major expenses on median priced homes currently consume 32% of the average national wage. That's above what banks will lend at. And it's really, that's if a third is going to housing, what are you going to use to buy food, transportation, insurance, medical insurance, and all the other things, taxes that you have to buy, right? So it is unaffordable for your budget, in addition to the fact that you're not going to get a loan. Also, we've seen a very high percentage, 82%, who really were having buyer's remorse. And this is recent home buyers. It's a study by, one of the real estate companies. So again, you can ask me for this chart if you want to see it, but that's telling you something, is that they didn't realize, a lot of them, they didn't realize how much it was going to cost in the closing. They didn't realize how much they were going to spend on insurance or maintenance or gardening and that sort of thing. So there's a lot of things that go into being a homeowner, fixing stuff. You got to fix your own toilet when it breaks. You got to fix the roof when it leaks. That's a lot of expenses that people are not necessarily factoring in. So again, real estate more than doubled since the Great Recession, but before, during, and after the recession, 20 million foreclosures, 20 million. And by the way, most people don't buy low because they can't. If you buy high in real estate and the value of the home drops below your mortgage, you're stuck. You can't really sell it unless you get permission from the bank to short sell, and then you could have a phantom tax bill. You certainly can't buy low because you bought high. So it's pretty important to make sure that you're on the right side of the trade. And right now, real estate prices are at all-time highs. So again, here's the things you need to be considering: that you want to know the area, you want to pick the leader, you want to buy low and keep it in the family, you want to buy what you can afford, but you also want to be aware that buying high on real estate can ruin your life for a decade or longer. You can't sell, your credit is ruined, you might be paying through the nose, and you could get a giant tax bill on phantom income. So let's go ahead and move on now to some of the solutions to unaffordable housing and home prices at an all-time high. And I want to show you a couple of different blogs as well. One of them is the aging mom didn't want to discuss the dilapidated house. And that's something that you really want to be aware of, is that there might be some low-hanging fruit in the family. Rich people are thinking about 3 generations, and they're planning 30, 40, 50, sometimes 100 years in advance. Are we thinking about just ourselves, or are we including what we could be saving if we were thinking about our parents and our kids and all of that? So let's take a deeper dive into that. Some of this real estate that could be hiding in plain sight, like an elder living in a dilapidated house that they can't maintain. Royals don't buy their own homes. And again, I did talk about that, a lot of nuclear families are not considering, generational wealth. They're making landlords rich, or they're making banks rich. And again, this dilapidated home, this particular opportunity for this family, the mom was living in a garage that the kids had remodeled for her. The home was so dilapidated that she was actually living in an RV. They made a little apartment out of the garage, but the home is still ready to fall down. And why not go in and go ahead and fix up the entire home instead of having the parent live in a little apartment with next to an abandoned house? If they put, one of the other kids in there, then the parent's going to get interaction, social interaction, and better meals. So that's what I mean to say about things hiding in plain sight. If we start including generational wealth, then we can start thinking about, can we keep this home in the family? Do we need to tear it down and rebuild it? We already have the land. That's going to be a lot less expensive than if you go buy something that's already built. So that's one of the areas of opportunity that is indeed hiding in plain sight. 3 generations could easily be spending anywhere from 2,500 to 5,000 per month each. That's 90,000 or $180,000 per year. Could that money be better spent? Again, we talked about the dilapidated house. 17% of homes purchased in 2024 were multi-generational. So their families are coming together to solve this problem. My concern is still that you're buying high. So that's why I would say, let's see if there's real estate that's hiding in plain sight that we can repurpose. And I will give you a few examples of that. So again, even if it's only 2,000 a month, that's 72,000 a year. That's $1 million home that you could be paying, even at today's higher interest rates. Partnerships allow you to solve bigger issues. If all the family is pitching in to fix the plumbing, that's going to be less per person. You can keep the money in the family and stop making the landlord and the bank rich. Should your real estate be in an LLC? Should you live in an ADU and give the big house to the kids? Should you invest in real estate through your IRA so you don't have capital gains if you sell it? Should you be giving LLC memberships to family members under the gift tax level steadily, or the person who you have decided is going to inherit it? So again, I do know someone, and she was ready to retire, and instead of downsizing, she gave the big house to her kids. And they built an ADU, so when she visits, she has a granny flat. Now she has her own place that she bought too. It's just smaller. Also, I know another professional, when she retired, she had a big house, a beautiful big house, but she decided she wanted to travel. She had a pension, but it wasn't as much as her income. But when she rented out the big house, the pension and the big house income, rental income, was as much as she was making when she was actively working. And she traveled 6 months out of the year, and she downsized into a smaller place on a golf course because she likes to golf. So it's important for you to be thinking about these things. And instead of thinking I'll sell it and get a boatload of money and then I'll have a lot of money and I can will it later, think about how much that people could be keeping the money in the family if they weren't spending so much on housing. And how can we solve that issue? There are also 2.3 million mortgaged homes that are severely underwater on their mortgage. Now, you may have this in your family, and that person may not be telling you because people don't. There are many Americans who are struggling and ready to downsize. Now, is it time to come together and have these conversations? Again, rich people talk about their wealth. They talk about which home their kid is going to live in, or which room in which home the kid is going to live in, where the parents are going to live. They even try to monetize it. And we'll talk about that in just a moment as well. So middle class and, nuclear families need to get a little bit better on that as well. All right, we're going to talk a little bit more about investing in buying an apartment building or a storage unit, or even on Wall Street, a commercial real estate REIT or something like that. So private placement REITs, where they come and say, hey, you can own part of this apartment building, you can own part of this storage unit. Most of the time, you're investing in the company that owns it. You don't actually get the title. That is called a stock. So you have ownership in the company. You don't actually own the title. And that's important because you're going to be sold into it to say it's safe, you own it, and it's real estate, and it's doing well because it's a storage unit or whatever. You are told you own the real estate. You are not provided with the P&Ls of the company that owns the real estate. You are offered a high yield. You can't access your money. You might lose a lot of your principal investment. And meantime, the broker could have made 6 to 7% commission on the sale. Now, there's another blog, and these people actually, it's a guest blog written by a couple who was sold into a lot of those. The broker made a lot of money and they lost $18,000. So it's really important for you to understand that, if you are going to invest in a REIT, you need to know how much debt the company is carrying and what kind of profit and losses they have had for the last 3 years. Most of the time, they don't give you that information because they're a private company, right? Now, if it's a public company, you have access to that, and that's important too, because a lot of people are getting sold into public REITs for the income. So they're saying, hey, you can make a great income on this dividend. And you're told, don't worry if it's a paper loss, it all works out. You're offered a high yield. The company gets into trouble and cuts the dividend. The stock drops precipitously, and your investment may be in danger not just of losses, but of total loss. So we saw that with Hudson Pacific Properties. They had a Google campus planned before the pandemic. And then that got abandoned. And of course, you can see here on the right, that's an empty lot. That's a picture I took in December of 2024. Before their stock dropped in 2022, their yield was as high as 19.12%. They had to cut that dividend. And as you can see, when they did, the stock went down ultimately $28 to under $3. Mace Rich is a mall. Its yield was 7.23% in 2022. The company gave Santa Monica Place back to the lender in June 2024, and Mace Rich is another one that experienced a lot of losses. So again, be very careful with being sold into funds for the income. We actually are using income value replacement funds. In some cases, you're getting a lower risk for a much higher yield. So a lot of the yield in the US, if it is above 4%, you might be going into junk bond status and not even realize it. Those are both junk bonds, Mace Rich and HPP. So very important if you are going to own your own home and buy it, that you really know what you're doing and maybe think about looking in plain sight for what real estate might be available. And if you're going to buy into a company that owns the real estate, that you know how much debt and profit, what their profit and losses are looking like. I'll show you a few stock report cards in just a moment. But this one is another area we were going to talk about because, look, there are areas like half empty office buildings. If you're walking down in your city, you might see a lot of commercial buildings that are empty. And people are saying, hey, we should just convert this into housing, right? But it does cost to do that. So we saw this group of millennials. They were actually featured on a CNBC. They bought an abandoned school for $100,000, but what they didn't realize is how much it was going to cost to renovate it. And it was a lot more than they had factored in. So it ultimately ended up that the total costs were 3.4 million. They have a $2 million mortgage, and other apartment buildings close by are worth about 1.5, so a lot less. In addition to that, they may be cash negative because they don't have enough income to cover all of their expenses. So again, before you do a project like that, you better really have someone who has done development and does real numbers, not dream pie in the sky numbers. Because to think something is going to cost you 2 million or 1.5 and that you're going to have 50 units and it ends up costing 3.5 million and you only have 30 units, that's a big difference. So again, here's a senior housing stock report card. And senior housing REITs are doing better. You can see that, but they're also very expensive. So the share price could go down just because they're so expensive. As an example, Welltower has less than 1 billion in net income last year and it's worth over 109 billion. That's a very lofty valuation, very expensive stock. Also, not all of them are doing well. Brookdale Senior Living is losing money. So we're really underweighting real estate in our value funds, and we're using value replacement funds. So as an example, our Peruvian fund that we're using, it pays a dividend or its yield was above 4%. And it has been way outperforming like the Schwab dividend value fund and other value funds. So there are ways that you can have greater performance and more income and even potentially less risk. So that's what we're doing for our value replacement funds. So again, be careful of REITs and value funds. Over half of the S&P 500 is at or near junk status. Here are even builders. So you might think, well, housing's on fire, so shouldn't the builders be doing well? But no. KB Home is losing revenue, Toll Brothers, Hovnanian, and Boxable really is down. It's just now going public through a SPAC. So be very careful. You don't want to just read the headlines or the emails that you're getting sent. So I am going to talk about a few projects that do it right. And real estate is a long-term investment, and not everything will go right when you invest in real estate. And that's why it's important to have partners and to have a vision and to think about even how you're going to pay for it all, right? And you want to be thinking not only of the income that it could provide, but also, are you buying it for a good price? So it will later, if you do wish to sell it, that you can sell it for more than you paid for it. Now, Synergy or Ranch, it's a collective group of people. They didn't buy into a REIT. They actually came together as a group. They bought the ranch. They built their own casitas. They actually built a geodesic dome and a conference center. Then they built their own ship and sailed it around the world. They purchased a gallery in London. They have a boutique hotel, so they get income from both the sale of the art as well as the room sales. Then they went and they built a biosphere. Now, Biosphere 2, it ended up going to the University of Arizona, and now it's a nonprofit project that's funded by an oil man. So again, not everything is going to necessarily work out, and that's why you do need to be aware of the fact of maybe, extra real estate goes into LLCs. Maybe it is something that's I invest in through my IRA where I don't get capital gains if I'm able to buy low and sell high. So these are all things that you definitely want to be aware of before you become a property or real estate or a homeowner. And it's twofold. It's not buy a place and rent it out on Airbnb and you will get so rich, rich, rich. Well, if you buy high and the value sinks and your mortgage is here and the value of your place is here, you're stuck, right? Now, what happens also in that scenario is maybe you're not renting it out as much. So now you're having trouble making the mortgage and the bank is really mean to you at that point. Your FICO score has plunged because the value of the home that you just purchased has plunged. There's a lot of problems. So again, I would strongly recommend that you check out the real estate section of the ABCs of Money, sixth edition. Sixth edition, right? I do update it because the economy does change. I had to update it in the pandemic, and now it's a new world again with real estate at an all-time high. So there it is. Just go to nataliepace.com and click on the book cover. Also, we spend time, and the day 3 is what's safe and how to get safe. And we also talk about real estate in day 1 when we talk about money while you sleep in your liquid assets. So, real estate's a hard asset. It's not easy to get rid of. You actually have to know, that you have bought something that somebody is going to want to buy later, or that you're going to be able to monetize it through the rough times. So we'll talk a little bit more about how some of the families who keep their wealth in the family for generations do it. Now, before we do, Deborah thought she was getting a bargain buying this hotel in a little old west town for 75,000. The renovations ate up her retirement and cost an additional $100,000, but she loves the sanctuary that she lives in, right? Um, so she's going to make the best of it. She wrote a blog about this. This is not, me outing her. And you can actually access that blog if you would like a link to it. Email info@nataliepace.com. I'm happy to send it to you. But again, that's an example of, oh, I'm just going to buy it and it'll be so much fun to be an Airbnb owner, right? And then, of course, you get sober once you start having to actually rent it out and remodel. Now, the Duchy of Cornwall is owned by the royal family, and it owns Highgrove, Poundbury, Nanslater, Mastormel, many other villages. And this is another thing I was going to say. You saw that slide where I said royals don't buy their own real estate, right? So, Prince William, he's now known as the Prince of Wales. He and Catherine first lived in Kensington Palace, and now they're going to be moving into Windsor Castle. They have other places that they live in as well. They all go to Balmoral this time of year for a family holiday. But in addition to that, they have ways that their land and their properties bring money in so that they're monetizing it. So, as an example, Restormal is a manor house. I actually rent it out once for the full week, and I go there with a group every 2 years. This is King Charles, personal residence. It's called Highgrove. You can go have champagne tea and do a garden tour there. Nansladen and Poundbury are both planned communities. You can actually freehold if you buy the place, but they do own where the commercial real estate is and that sort of thing. So that's something they monetize. Also, they're monetizing it by selling the real estate to you. So these are just ways that other people are doing it. Now, as a reminder, debt is at an all-time high, all debt, whether it's household debt, so that's consumers, corporate debt, our public debt, which you hear about, the total debt and loans is 103 trillion, but also stocks are at an all-time high and real estate is at an all-time high. And that is a time when you should be a little bit more cautious. And again, I want to stress the fact that most people do not buy low because they can't. If you lose money, if your stock portfolio drops and your value of your home drops, your net worth is less now. You don't have any liquidity. You're struggling to keep up with everything. You're not going to be able to take advantage of low real estate prices. So it's important for you to keep your money. I think paper losses are not a good idea. Again, people who are using our safe strategies are not experiencing paper losses and they're earning a higher yield as a result of both that and the fact that we found areas where you can get a yield without taking on more risk. So again, you can email us for access to that asset bubble chart for if you would like the REITs stock report card, so you can see that information for yourself. I also have blogs I just told you about. We have video conferences. You want to make sure you're signed up for those. And our quarterly educational retreats. I have an unbiased second opinion. So many busy professionals will say, will you just look at what I own and tell me whether or not it's a good idea? And I do that through my private coaching plan. Now, with stocks at an all-time high, if you get a second opinion, you would be, capturing gains at an all-time high. It's not market timing. You're not going to, jump all in, jump all out. That's not the way it goes. But we do have a time-proven 21st century plan that earned gains in recessions and outperforms the bull markets in between. And you definitely want to get that when stocks are high. It's a good idea. So whether you attend the retreat or get an unbiased second opinion, I strongly encourage you to consider it. The retreat itself, we actually have our summer sale going on, so you can save $200 and get a free coaching session. Plus, I'll give you access to the recording of my real estate masterclass that I just did in June. But this offer is only good through tomorrow. Okay, so through tomorrow midnight Pacific time, August 20th. And the Financial Freedom Retreat is online, so you have no travel or lodging costs. You could learn how to save thousands annually, how to protect your wealth, how to, financially independent, retire early, wisdom over fear, uncertainty, and doubt, adulting hacks that transform our lives, how to earn a safe yield without paper losses, all this and more. In fact, I have a masterclass about that the Saturday after the retreat. So email info@nataliepace.com. Call us at 310-430-2397. And we're here to help. We want you. I've been in the business of transforming lives on Main Street since 1999. This is my job. I love it. And we want you to be the boss of your money. And we definitely do not want you to get into the position that so many people were in who bought high. Same story back in 2005, 2006. If you don't buy now, you're never going to be able to afford it. So people bought high, they bought more than they could afford, they bought more properties than they were going to live in. It's a different story today in that we don't have as many liar loans, but we definitely have people that are stretching beyond their means and are unaware that some of them are taking on debt to make their mortgages. And debt is at an all-time high. So we are starting to see stress with the student loan debt just popped because they started reporting it, delinquencies and stuff. So there's more stress out there than you might be aware of. And opportunity if you shop in where things are hiding in plain sight. So I want to show you a couple more things. Be sure to go to nataliepace.com, check out my blogs in the menu, check out more information, including testimonials on the retreat flyer. All my books are there. Also, I think it's important for you to subscribe to YouTube so that you never miss any of our video conferences, and definitely follow me on Instagram because you'll get daily tips. I actually have an Instagram channel there as well that you want to make sure that you're signed up for. So thank you again for joining me. That's it for today. And real estate, the best opportunities could be hiding in plain sight. Thanks again, Natalie. Nice to speak with you guys today.